Hello everybody and welcome back to our special weekend edition where we discuss all of the markets around the world for the week ahead. We know that this has been a crazy year in 2022 and the double bottom that we've just seen breached on the stock market could bode well for some further bull movements. But is this all part of a greater bear bust? There's so much to discuss and so much fear out there that I think we need to break down so much in today's video. This one's going to be great. Let's look at everything to do with the markets right now. See you soon. Welcome back everybody to the daily show here where we talk about stocks, cryptos and commodities daily. If you like any of those markets, always remember to subscribe and smash that like button. We'll begin by talking about sentiment in the markets because frankly, it's really low. And we know this because we're getting reports in all the time. It's part of how we created a bull thesis that worked over the last 2 weeks and why the market is rallying now. 53.5% of people were bearish in this survey with 26.7% compared to 31 being neutral. And what you'll notice is last week, 25th of the 5th, that is May, 19.8% were bullish. What happened to the market after that? The market rallied heavily. We got the bear and bull indicator. Super bearish, super extreme fear. What happened again? The market rallied. And it does this a lot when everyone's feeling extreme fear. We also showed in our previous videos things like articles that were written, extreme bearish articles in the last couple of weeks in the newspapers, especially last weekend. And of course, what happens? The market rallies. Unfortunately, this is what occurs. You get put in this point of massive fear, and that doesn't mean that you're wrong. The market could turn around and it may do so later on in this midterm year. But at the same time, the fear that is being mungered to everybody tends to reverse and really put maximum pain on both sides. Net inflows were coming in pretty heavily throughout the week. And this just shows that, again, people were actually purchasing, most likely the street, Wall Street that is. And it makes sense because we knew that statistically it was unlikely to go down much more. We used this kind of stat here. Only 4 times in history had we ever seen over 7 weeks down in stock markets. That is the SP500 going back. Now, after that occurred, we usually saw a nice increase in stock markets, which is exactly what we've seen so far. Why? Because markets have to go back to mean reversion or equilibrium. And we'll show that on the charts as we discuss everything to do with the markets around the world coming into the next week. There's so much to really talk about here. Now, when we've had bad years, that is bad 100 days here at the start of the year, we do tend to have usually some big turnarounds. Sometimes it actually goes all the way positive. Now, that's not the only stat that you can use. Obviously, you can use stats here where you can say, okay, well, when big rallies occur, do they tend to hold up? But there are some outliers from these points. Noticeably, stagflation, which we could be in right now, the 80s, and of course, the GFC. So really, what are these stats telling us? Well, they're telling us one thing about that markets, that the rally seems to be here and that the rally should continue for a little bit to allow maximum pain to happen and possibly mean reversion in the markets. The 20 moving average is what people will be looking at, especially on the weekly charts for the stock market. We'll take a look at that again later on. So I thought I'd bring this chart in just to have a quick discussion here. A lot of people consider the stock market the most important market in the world. I often consider the real estate market one of the most important indicators in the world. And the reason why is simple. 90% of Americans, and that is most Western nations, hold most of their asset classes in real estate. So if real estate falls, what happens? They feel poorer. When that happens, what goes on? Of course, everybody doesn't buy as much and it leads to a really poor economy. So just always remember, it's good to have a look at these charts and just to understand why the global financial crisis was so extreme was because when real estate fails, everyone goes down. Not just the rich people in the stock market and some of us that have lots of assets in there. It's everybody else too. The general person out on the street that has no interest in stocks or anything else. Fear and greed index, as we've been mentioning, is very low, 21 here on the reading. And Friday's close was really extreme. I mean, that was a big move. And it was pretty much shown that it would occur. We weren't bearish as of really that 20% down on the SPY. As soon as it hit that level, we said it would be a defended zone here as a channel. You guys were correct. The good thing about it was that it meant that we couldn't really be as bearish as everybody else was. And I guess we've been paid off for that idea or that concept. Tesla up 7.33%, Apple up hugely as well. And if we look at the actual market movement for the day, it basically just ripped through the whole session, opened up, rallied through, closed high. And when we know the close is going to go so well as well, that generally means Wall Street is with us. What were they buying? Well, they were buying everything to do with risk. As we bought into the analysis over the last week, we've talked about how technology might outperform in this rally the rest of the market. The reason is super oversold. No matter what indicator you look at, technology got beaten in 2022 very heavily with a giant stick. And we know that things like PBW, semiconductors, XLK, and others, they all just did a lot worse than everything else. So they deserve to have a bit of a pickup in what is a bit of a risk-on rally here happening so far. Now, what's that done? Well, it's pushed our VIX down to a very important level, 25. You'll notice 1, 2, 3. Let's see if this can get broken. Remember in the last rally when we were back over here in March and we rallied into the beginning of April, we managed to get down underneath 20. So 25 will be a pretty big zone for it in the next week ahead. You can see if the market's going to go down through here, where's the next stop for it? 20. And the VIX or fear tends to like really gravitating towards these levels. PCC, put call ratio, coming back into the middle. It's not going to help us too much anymore. But I think if you notice and you go across to other points, when we had that huge rally coming through, we saw an increase in the amount of calls and then it went back to equilibrium before turning off. And that's why it's usually better to show us that output of people trying to buy puts in the market. And that's exactly what's been occurring over the last couple of weeks. We saw huge amounts of puts. They all started stabilizing, the market started turning around, and then all of a sudden we had that huge rally. Little surprise, they trapped everybody into being negative in the market to expire those puts over the next coming weeks, worthless, so then they can make the next decision. Copper, or Dr. Copper as we call it here on the channel and everybody else in the investment world does, showing some gains. That could mean positive things. Remember, copper is a bit of a barometer of how healthy the economy is, and right now it's holding, which is technically a good thing here for the economy and for this potential recovery here. Let's talk about US 10-year. That's also been dropping as we spoke about it over here. We thought this would be the high for now. It's making a series of long leg dojis or equilibrium points. So as we scroll into something like the 1 hour, you'll notice that it's basically holding in a range. Where's the important point? 2.7. If the US 10-year is able to break below the 2.7 level, that could mean that the street is starting to believe that the interest rates have really peaked, and it's a huge level here for the markets. It's very important that the 10-year gets underneath this zone and closes. It looks like distribution to me, possibly even a Wyckoff. I don't really do too much analysis on the US 10-year from that aspect, but certainly a bit of a positive. Let's hope it keeps going down. And if you move over to TLT, this is partly the correlated trade that we've been discussing. Treasury 20-year bonds. They're going up. Why? Because, of course, if the US 10-year goes down, Treasury bonds tend to do better. And it's kind of floating around waiting for that 10-year to move. Another thing that we've been really discussing is the idea that cash wasn't necessarily king over the last month because everyone started believing so. This was a false rally. We correctly as a community called that level. And at this stage, it still looks like there's negative movement here in the dollar index. That is, the market is continuing to come down, continuing to show that weakness. As the dollar weakens, what will that mean? Well, it could mean that money is going into bonds and money is also going on to risk on assets. So continue to watch this one. It looks in a downtrend for now, and you can see a little bit of a downward trend line that I've put in here. If that gets breached, and especially if we break past here, I could see a little bit of a rally, and I've got that 103. I'm watching that level for potential shorts to come back in over the next week. Let's move over to gold, another one that we've really been on top of so far. So gold's doing the right thing, though it's not explosive right now because I think it needs the US dollar to turn around. It's come into what we call a defended zone. It's defended it. It's effectively created a double bottom pattern here. You'll notice there it is. There's the breach, and it's come back down. It's hovering around that zone. So for now, gold is still holding some form of upward trend. Any breach underneath here will really expose this 18-15 zone. So I think I'd be very careful around here. But for now, it does look strong. And of course, it broke all those downward trends. So if you had any downward trends drawn on things like the 4 hour and the daily through those last peaks, once we got through this area here, you'll notice, I'll just quickly pop it in so everyone can see it. There it is. It started going bullish, and now it's consolidating, getting ready for the next big move. Down underneath here, I could see it way lower, and of course, breach above we could see it all the way up there to the 1900 zone. Gold's a little bit maybe underpriced in this current market. Now, XLY, XLP, this is really just showing us consumer discretionary versus consumer staples. But how I like to see it is risk on and risk off of the markets. Now, we discussed this being at support last week. It's why we thought that maybe we might see NASDAQ outperform the stocks, that is the SP 500, and it did so. Now we're at the double bottom resistance. So if we get another breach, where do we expect XLY, XLP to potentially go to? Back to the 2.2. So our performance here for risk could continue throughout the markets. It's starting to look better, similar to how the last rally was over here back in March. So here's the 8th of March. Here's the 15th, 16th, where things started improving. And you'll notice it ramped for a little bit there as part of that bear market rally, or at least the rally that ended up getting shorted off. Will it go up again? At this stage, it's looking positive for risk on. Let's move over to Tesla, another risk on stock. Now, it's gone and hit resistance through the Friday close. You'll notice it hit that 20 moving average. And this is something that's been respected a lot from the market, such as things like Tesla. Tesla has respected the 20 many times. And when it's breached, similar to last rally, it's really ramped. So I think Tesla's in a good place compared to where it was a week ago. We talked about this being the kind of last level before 550. It just held up. I guess for a lot of you guys out there, thank goodness it did. We talked about this. We talked about the breach. It's changed timeframe trend here, which is excellent. And it's now, really just fighting with all these zones. It is leaving some gaps in its wake. So what I mean by that is we've got a gap here around that 720. I think that could be a very cool level to have for the week ahead, just in case the markets do pull back a little bit here. In general, I think people will turn bullish, and the market has turned bullish when we look at the SP 500, but I could see this gap getting filled at some point potentially, and day traders to try to step in around that zone. A lot of fighting between the bulls and bears around that 720, 700, so I could see that being pulled back to for something like Tesla. Apple is kind of similar. It's left a gap in its wake. A few stocks came out of the gates incredibly strong on the Friday trade, and you'll notice it made a new low, potentially causing max pain. And now we've just closed at the resistance. We haven't really changed trend on something like a daily here for Apple just yet, only on the 1 hour timeframes. Things are looking better. It is at resistance, and it's the same story as really Tesla. Very similar resistance. Take profit zones on the next break could be pretty extreme. They could be upwards of around that 160 plus. So there's a lot of room here in Apple if it works through. But I think the market indices will show us the most. So let's move over to the DAX. Now, a lot of people don't consider the German market or other markets around the world when they're looking at whether it's risk on, risk off. But this was a really positive sign here from the DAX. It finally broke above that 14,250. Pullbacks now, what do we expect? Well, we expect buyers to come back in and try to show some commitment there. This is a huge deal. Let's look at this on a daily just to break it down how big a deal this is. And you'll notice that downward trend, super significant. The inverse head and shoulders that a lot of people will have on their charts now. Left shoulder, head, right shoulder, fantastic. The movement now towards this 14.8 makes sense. And this is where the synergy of all the markets might come together. Because 14.8 would be, let's say we pull back and then we go to 14.8. That would be very equal to filling some gaps here that we may need to do on the S&P 500 as well. Let's now take a look at IWM, take a quick look at that and see what's going on. Russell 2000, the small caps really have led the way recently in terms of rebound. You'll notice the rebound occurred around the 11th and 12th of May. That was the low that was put in. It showed us the first signs. We looked at it very closely because you know what? It showed us them over here as well for the rally. The thing with IWM is it can go up for a little bit, and then what happens is Wall Street sometimes show their hand as well by dumping it and it underperforming, if it's a false rally, it underperforming the other markets like the SPY, like the Dow, like the NASDAQ. People move into the bigger stocks because remember, these big funds have to be invested. They can't really cash up all the time. So they start to rotate out of the risk on and into the other sectors. Let's see if they do it again, and that's one of our signs that maybe this rally isn't real, because that is still a possibility. We could be just in a bit of a false rally here. 190, a big contention level. I think just above that, around this area here, around that 193, will be a pretty big point here for IWM. But so far, so good. Nice lightning bolt, nice movement out. certainly doing the good so far. Let's move over to the Dow Jones. Now, this is where all the analysis comes together. So realistically, with the Dow, we have a huge amount of support that's been formed before. Resistance support, the last rally, all those things. At the moment, the Dow's been quite strong. It's changed trend on the daily as we see it first time